Hi, and welcome to the RPA Property Seminar. I'm Josh Phelps. I'll be joined today by Michael Wales and Elliot Rowe. Hi, guys. Combined, we have over 30 years' experience within international property investments. Next slide, please, Mike. As a company, we work in partnership with developers, advising and distributing products throughout the Middle East, Far East, Africa, and Europe. Next slide, please, Mike. So, fundamentally, as with any investment, it's the research and due diligence at the front end that underpins everything. We make sure that we take on projects that will outperform with great developers that are well capitalized, with strong track records. So when we present developments to our clients, we know that they're robust and they will deliver. In terms of the investment advisory process, we act on a very consultative basis. So property certainly isn't a one-size-fits-all type of investment. So depending on a client's circumstances, in terms of kind of capital available, mortgage availability, and timeframes, we will then look at what property will suit their investment needs. On the conveyancing side, it's quite simply the legal process. We facilitate that. We work with independent solicitors who act on your behalf, so they protect your interest as the investor. We can also facilitate mortgages, either directly with lenders or through our kind of partner mortgage brokers to ensure you get access to the best products on the market. For lettings and management, we have an in-house lettings and management company, and this is to ensure that the handover, snagging, finding the tenants, vetting the tenants, renting, and ongoing management is as kind of efficient as possible. And then eventually, when you want to exit the investment and liquidate the asset, we can help out with the resale of the property back onto the secondary market.
Thank you very much, Josh. Hi, everyone. I'm Elliot. So essentially today, I'm going to be, we're going to actually be focusing on the UK. As I say, we have got experience in other sectors around the world, but today's going to also be about the UK property market and why we see this asset class as probably one of the best in the world when we're looking at it from a real estate perspective. Some key factors just to think about and look at when we're talking about the UK is you can see from the points I've got up here, but the leverage elements and the cost of finance, the passive rental income, the diversification when you're looking at other investments. Many of you, I'm sure, have investments in different sectors and different markets around the world, but it's like adding diversification by looking at UK property. And then there is also, again, for many people that are living overseas, looking at this from a succession and retirement planning perspective, that we can go back to look at what's going on, start using that asset when we're in later life. So looking again at why the UK, now there are a number of factors, as you can see up here, that really do show why we as a company and really focus on the UK and why you as individuals will want to look at this in more detail and understand the sort of the ins and outs of the market. A couple of things for me and from my experience that really do sort of underpin and are the fundamentals because of or why it is of the UK is the supply and demand issue. And so if you're considering the UK needing about 300,000 properties a year to be built, last year was 120,000, year before that was 180,000, year before that 175,000. So there's a chronic undersupply of property. When you then combine that with the fact that it's an incredibly stable and strong market, it's been around for hundreds of years, got the legal system there to support it. These are sort of fundamentals that have been around for a long time, and therefore looking at the moment and today and why we should be something to look at today, we can really think about things like the favourable exchange rate. You're saving about, if you're purchasing from in dirhams back into pounds, there's almost a 13% saving purely on the exchange rate. Next slide, please. Now, this graph really goes back to, say, one of my key fundamentals, which is the supply and demand element. When we're looking at this graph, the orange bars are the new sales instructions, and the green is the prospective buyers looking at the market. Now this is literally for last year and so since 2020 and 2021, and throughout this whole process, that there have obviously been many other factors like that have led into this, but moving through 2021 and then actually now into 2022, we're starting to see exactly the same sort of correlations, if not actually more extreme. And again, this is really what underpins the market and keeps that stability. And when we're looking at the graph that's going through the sort of grey line that works through the middle of the graph, we're just seeing what's happening with the house price index. Next slide, please. So going back to looking at things over a short-term period and what has happened since 2020, and obviously we're all very aware of COVID and Brexit and all these sort of other elements that have affected the market. But then we can look back at the UK since the 60s when the results and everything were starting to be correlated, and you can see there's a steady upward trajectory throughout the last 30, 40 years where we've seen the results being recorded. A really important element here is when we're looking at the UK and when we're looking at the world economy, a bit like we are now, with everything that's happened through COVID. But if we look back to say 2007, we had the peak of the UK market in 2007, and the world economy was booming. We obviously had 2008, 2009, the fallout. But what happened was that we saw a very steady recovery from the UK property market. And a key reason for that is I think people around the world, when they were investing in other asset classes and other investments, actually saw the UK housing market, because of the history, because of the stability, because of the law that sort of controls the whole market, as a very stable environment to invest in, and that is really well explained from using this graph. Next slide, please. Now, I just wanted to find a bit of research really as to what is going on to the market. And, looking at this is obviously I have my own personal view, but then we're also all of our research is actually based on what third parties and large PLCs who have hundreds of analysis working for them, and you see what's going on. So on the first comment you can see here on this page is from the head of real estate at Stroke Parker, so obviously a large PLC in the UK. Now, this is at the beginning of the year. We're saying how we're looking at how optimistic the economic outlook is looking, and that the market is at the strongest it's been. We had a very strong 21, so coming through 2020 as well was actually strong even with COVID. And then predictions moving forward, over the next 5 years. Again, these are great results. So between 20 and 35% increases in capital appreciation. The comment after that, which is by Robert Gardner, who's the chief economist at Nationwide, was released last week. Now, again, this is a really to date comment, and it's live and it's very very liquid, I suppose, as we're sitting here today. And now we're all aware of the high inflation that's going on around the world and the cost of living and everything, especially in the UK. But yet, what is still underpinning things is that the UK housing market and house prices are going on that upward trajectory. And again, that comes down to ultimately the stock levels. When you combine things like the unemployment rate being at 50-year lows, the job vacancies that are at the high, you can just see why the UK is a robust economy, and from a real estate perspective, it's really something that is a safe haven, seen by many as a safe haven. I'll just pass you over now to my colleague, who will bring you through the next element of the process.
Thank you for that, Elliot. So I wanted to touch on a few things that we get asked on a daily, weekly basis, really, especially dealing from an international investor's point of view. Even if you are a British national living outside of the UK, some of you may not know or understand that you can do some of these points here. So when we look at owning the outright title of the property, now in the UK, yes, there is a leasehold and there is a freehold. So generally, houses are freehold, and an apartment investment, which we predominantly do, would be a leasehold. Now, historically, that did become an issue, but now all of our new build properties are a minimum of 150-year leasehold, going up to 999 years. So you can pretty much call that a relative, freehold, virtual freehold, really. When we're talking about valuation risks, we're looking at investment-led projects. Now, there's a lot of investment-led projects that are sold globally, and we are very specific with the developers that we use. We make sure that there is at least a minimum of 50% of that project is being sold to the local market. Now, that's important. And the next point is talking about mortgages. And when you are looking to get an international mortgage, which you can do wherever you are around the world, the banks will look at each project and understand whether it is fully sold to investors internationally, or if there is an amount of local demand and local people living there. And if it's not, then the likelihood is that the banks will not lend on that project. So it's very important for us not only to obviously provide the investment for our clients, but make sure on the back end, when they're looking for mortgages, they are going to be available. We're looking at currency risks, as Elliot mentioned a minute ago. The pound, you could argue the pound is weak at the moment, but the dollar is very strong, as we know. So we're based here in Dubai and pegged to the dollar. So it's a great opportunity for people to invest back into the UK or into the UK, with it being so low at the moment. But generally, we're looking at that, and it's actually the lowest the pound has been. There's only been this low 3 times in the last 6 years. So that's showing how strong the pound, on average, how strong the pound is. And the likelihood is that that's going to recover quite quickly and just remaining a strong currency in general. Now, obviously, being in the Middle East, there are purchasing across the world. We have multiple nationalities that are buying through us and investors through us. And sometimes there are some language challenges, but we do have some Arabic speakers on board and other nationalities that are able to help, in particular with the whole process of purchasing the property to using independent solicitors. And Josh mentioned about our solicitors. We do have some Arabic speakers as well that can assist throughout the process. And ultimately regulation, and I think Elliot mentioned about the legal system and the regulations that are in place in the UK, and that really underpins why we are always looking at the UK as a major location for our investors, because of how strong the regulation is, and all the funds are protected going through your solicitors rather than dealing directly with the developer. I just want to also cover a couple of the payment structures and a couple of costs that would be involved in the process, but also things to be aware of. Obviously, if you are looking across the market and looking at other projects out there, just be aware of a few of these highlights. So, all of our projects will have deposits of between 10 to 20%, and that's on exchange of contracts. Now, if anyone is looking at 25, 30% or even higher than that, that is a red flag to us. That is really, when you're looking at that, the likelihood is the developer is probably using the majority or a large proportion of your funds to help fund that project and actually build that project. So if there is anything 25, 30%, the first question I'll be asking is, do they have funding in place? And can you get proof of that funding in place before you go ahead and commit anything? When we're talking about your deposit, yes, all of our projects, we have an insurance policy in place that protects a large proportion of your deposit. And that is there. Obviously, all investments are a risk, and property is, there is a slight risk in that. So what we do is we have that policy in place that if the unfortunate did happen and the project didn't get built, then actually that would help cover a large proportion of your deposit in that scenario. We can provide a detailed cash flow for all of our projects. Every single one of our units, we're able to show you detailed legal fees, mortgage fees, and also service charges that are involved in all of your purchases. And that's something, again, that it's nothing to hide from, and we're very upfront with that, and we want to make sure that everyone can see where all of the costs are coming from, and ultimately what is that big figure that figure that you're going to have to come up with from a cash perspective to go into that investment. And service charge is a big thing. It's sometimes it's a concern, and some of the investors will bring it up and say, well, that looks expensive, or why am I paying that? Well, ultimately it's to protect your investment and the value of your property, because that service charge will go to looking after the communal areas, the actual building that you have. It will cover your building's insurance for your investment as well. So it's not relying on all owners to club together and fund a repainting of the property or looking after the communal areas. So it's important to have service charges there that will help, obviously, with your investment as it grows in value. We often get asked, should I pay in cash? Should I pay in a mortgage? We thoroughly believe that the power of leverage is the way to go forward. With regards to a mortgage, I'm just wanting to bring up this it's quite on the basic level of what this looks like. So if a client was going to invest £250,000 into an apartment, and we looked at a 5% appreciation over 6 years, the apartment would now be worth £325,000. So it's a 30% increase, and it's £75,000 over that time. If the property was rented out £1,000 a month, so you're getting £12,000 income per annum, the total profit would be £147,000 over that term, over that 6 years. So your return on investment will be 58.8%, which is great. You're getting that over the 6-year period. It's a very good return on investment. But actually, if you look to leverage on your property, which property is the only asset class that you can use a mortgage, you can leverage on. And if you look at that scenario, a borrowing of 70%, so 70-30, you'd be putting in 30% deposit, which would be £75,000. Exactly the same appreciation over 6 years, renting at exactly the same rate, and you can have a mortgage interest rate of around 4%, which is, that is available on the market today, so that's realistic. Ultimately, the rent will cover the mortgage, so you're in what we call a neutral cash flow position. What that will mean is your total profit will be £75,000. So your total return on investment over that period of time is actually 100%. So you're using someone else's money to increase your return on investment over that period of time. So we do understand the mortgages aren't for everyone, but it's definitely worth reviewing this and taking a look at any investments and looking at those opportunities that we have with regards to leveraging your investment. Okay, we do get asked a lot of tax questions, and my colleagues here, they certainly have that, I know, on a weekly basis. We're not tax advisors, that's for sure, but we do have some independent tax advisors that we can refer you to. But just on a basic level, if you are a British passport holder, EU passport holder, or part of the European Economic Area, then you will be eligible for a personal allowance, a tax-free personal allowance. And as you can see on the graph on the left, the personal allowance currently is £12,570. So if we went back to the previous scenario of earning £1,000 per month, then you're going to be under that, so you won't be paying any income tax on your initial investment. So you can have one property in the UK and not be paying any income tax on that property. Now, everyone's scenario is different. Everyone's situation is different as well. So this won't apply to everyone that's watching today. But as I said, we do have some independent advisors that we can refer you to if you have any questions regarding the tax on the property. So we're just now going to quickly touch on a couple of investment opportunities that we have. We have the Bookbinder Point, which is in Acton in West London, which I'll refer over to Elliot. He's going to talk a little bit about that property. And then we have Scholars Quarter, which is our premium investment in the Jewellery Quarter part of Birmingham, and Josh will be talking about that.
Okay, hi everyone, back again. So just looking at London, and I fully appreciate that lots of us really, that if we're thinking about the UK as the first city that we think about is the capital, is London. And people have had phenomenal success from investing in London over the years. And you can see from the sort of figures here that those sort of successes are probably going to continue. You've got sort of house price growth over the next 4 years or so, about 23%. Rental growth is incredibly strong as well. Again, going back to my comments earlier, just talking about the shortfall of homes, which we see in most areas of the UK, there is a significant shortfall within the capital and a growing population. I think fundamentally, regardless of whether we're looking at London or other areas of the UK, it's a small island with a huge population, so there's always going to be. Now, as Josh talked about earlier, as a business, we're looking for investment opportunities around the country, and as I say, London has been very successful over the years. But when we're then starting to look at particular cities and things like that, we've got to look for particular reasons that we feel there's going to be significant growth from capital appreciation, but also there's also going to be a demand for rental or increase in rental demands. Typically, that comes from new infrastructure within areas. Now, you may or may not be aware there's a new tube train line within London called Crossrail, Bookbinder Point, which is the project I'm going to talk about now, is on Crossrail. So it basically significantly changes the area from an access perspective. So London and the house pricing within London, demand for particular areas of London is so important to have good communication and good tube links. You'll see pockets of London actually that won't increase in value, or you'll find it's very poor housing and things like that, and that will generally be because of the poor communication that's in the base there. So Bookbinders is on Crossrail. It's based between Acton and Chiswick. Let's go to the next slide, please. And this is the project itself. So as I say, project booked nicely positioned in between sort of Chiswick High Road and Acton Town itself. Chiswick High Road, extremely high value area within London, arguably one of the nicest high streets within London itself. Close to the River Thames, you've got the green open spaces of Gunnersbury Park, you've got Richmond Park not a million miles away as well, Kew Gardens, the river. You then have the high street itself, which has fantastic shops, restaurants, cafes, bars, great schools, both in the private and independent sector, so local sector. And there's basically this area between Chiswick and Acton, which is this growing area, and historically, obviously, would have been a village outside of London, and as London expanded, etc. But it didn't have the money and the money spent to improve the area or anything like that. Well, that's completely changed now. And Acton is probably seen as one of the areas that's seen a lot of new investment and seeing new house builders coming in and creating new environments. So we're sandwiched in between those two great areas. There's 4 tube or overland train stations within walking distance of this particular development. And the finish will be exceptional. 1 and 2 bedroom apartments, starting from 460,000. Just a bit of sort of key facts about the project itself, who's building it. So it's a joint venture between Vision Develop and Hurley Capital, 2 very established developers within London itself. It's notice the prices, the addresses here. So, and really interestingly, bottom right hand corner of the screen, looking at rental yield of around 5%. Now, typically in London, I worked in London for 14 years or so, finding anything with north of a 3% rental yield would be really significant. So being able to get that sort of 5% rental yields as an average is really makes it very interesting. Price points, when you're looking at it, 1 bed's for 460 and 2 beds like 600. Less than half a mile down the road, you'll be looking at 2-3 times that value. So again, you can see why there's reason for growth here. A few sort of basic terms, sorry, just quickly on that, thank you. A few little basic terms. Again, this is quite interesting as well. Not every purchase you would look at would look at a 10% deposit, whereas this project does. So you'd be looking at putting 10% down within 20-21 days of reserving and deciding to go ahead with that, and then the rest, the following 90% will be on completion, which we're looking at is Q1 2024. And we'll now pass you over to Josh, who will talk you through Birmingham.
Cool, thank you, Elliot. So Birmingham is absolutely booming at the moment. Birmingham presents all the fundamental qualities of a city prime for residential real estate investment. The infrastructure developments, the airport renovation, HS2, which is the high-speed train line from London. Phase 1 will go up to Birmingham, and then 2 will go up to Manchester, I think Leeds afterwards. And more recently, the number of banks and large corporations moving their operations to Birmingham is substantial. So, as you can see there, Deutsche Bank, PwC, BT, Goldman Sachs, HSBC, I think HMRC, and a few others. So really, really quite substantial. The main growth indicator for the city is the housing supply shortage. Similar to London, Birmingham's population is growing at such a fast pace. The already significant imbalance between the demand and the supply of new property is increasing. And as a result, this is a force which is driving the rental prices and capital values as well. Next slide, please, Mike. Thank you. So this is Scholars Quarter, our latest development in the Jewellery Quarter in Birmingham. Price is starting at just shy of £200,000. It is a 999-year leasehold. which, as Michael was saying, this is effectively a freehold, unless you're going to have the investment within your family for 10 plus generations. Effectively, it's a freehold. Rental yields are expected at around 5.2% gross, with an estimated completion Q4 next year. The deposit on this is 20%, so that's leaving 80% remaining, which should probably be 15 to 20% in most cases made up by equity input. Match that with a mortgage to complete. If you show the next slide. So this is probably the most significant slide for me. So as you can see, on the bottom half, all the red brick buildings are all, this is the Jewellery Quarter within Birmingham. As you look to the top, that's kind of the city centre. And as you can see, Scholars Quarter, which is kind of bottom right, is one of the very last few available sites within the Jewellery Quarter. And why this is so significant is that the Jewellery Quarter is a conservation area. So what that means is you can't build over 5 stories. So therefore, once all the sites are kind of built on and the old red brick industrial buildings have been redeveloped into kind of luxury apartments, there's going to be a very, very finite supply of new property coming through. As we're in kind of the city centre or other areas, you can build the towers that you see, that can't happen in the Jewellery Quarter. So the finite supply is really, really significant. And on this map, this is about a year old, this picture now. So on just the right-hand side of the Scholars Quarter where the yellow crane is, that's the Copperworks, which is a successful development of ours from last year, which is pretty much done now. I think it's handing over. So where this is if you look at Scholars Quarter, you can walk through Scholars Quarter, through the Copperworks into Paradise Circus. And what that area is, that's the new kind of corporate hub of Birmingham. This is where PwC, Deutsche Bank, HMRC, this is where these corporations and banks are moving their offices to. So therefore, this is going to become the tenant pool for the development, which is really exciting. And it is literally a 10-minute walk. I've done it. So yeah, really, really exciting, great developments, and the location just speaks for itself. Next slide, right. So yeah, a bit of an overview. Developers King Crescent Homes, we've worked with on numerous developments now. As I just said, they've built the Copperworks, which is great success. Tenure, as I said, 99-year leasehold, fantastic. Completions Q4 next year. Total of 100 units. We will only sell approximately 50 to 60% of these off plan. I think Michael touched on this earlier, but it's to make sure if a development is sold entirely to the investor market, the banks may see this as no local demand. So we'll only ever sell kind of 50 to 60 units within the development max. It's all built up of 1 and 2 bedroom apartments. Ground rent is 0.1%, service charges are £1.60. It comes with a standard 10-year warranty, as you'd expect. And yeah, pretty impressive rental yield, 5.2%. I think that's it for this. Michael?
Yeah, no, that was great. That was great, Josh. And thanks very much, Elliot, as well. It's, I want to thank everyone for joining us today. And certainly that if you have any questions or want to contact us further, you can either visit us on the website or contact us via the email address where you received this link from. And we look forward to seeing you again soon on our next presentation. Thank you.